You know, it's interesting. The things that we're short are generally trading at 50 or 100 times earnings or losing money. Those are your sort of choices of the things that we're going to be shorting. So within that group will often be certain types of FANG stocks. If they're not earning a lot of money yet and people are pricing it on 2024 earnings, and they have a lot of high hopes involved there. And we're not really opining. We own hundreds of stocks on the long side and hundreds of stocks on the short side. So the bucket of companies that are trading at 50 or 100 times pre-tax free cash flows or losing money, historically, that's the world's worst investment strategy. There will be some winners within that group, and you'll actually know their names because they won. But I call that the tyranny of the anecdote. Okay, it's really the world's worst investment strategy as a group, but some of them will win, and you'll know their names because they won. But as a group, it's a bad investment strategy. So we're really concentrating on companies that have 7, 8, 9% free cash flow yields in a 3% interest rate environment. And while some of those may be priced cheaply because the people are a little concerned about the future, even though they're earning lots of cash flow now, we try to stick to companies that are gushing free cash flow, huge returns on capital, meaning they deploy their capital well. That avoids some of the value traps from traditional value. And so I think that brings up the point, we don't really think of value as low price book, low price sales investing. We're actually valuing businesses based on cash flows like a private equity investor would. And so if you're trying to figure out what a company's worth and buy it for less at a bigger discount, that will never go out of favor, even if value as defined by Russell or Morningstar, which is low price book, low price sales investing, that may or may not stay in vogue. It may be out of favor, sometimes in favor, may not even outperform the market going forward. That doesn't mean that much to me because those are have been correlations that have worked with more than your fair share of companies that are out of favor. I don't imagine they'll come back at some point. But we're actually valuing businesses based on cash flows, and that's what stocks are, ownership shares of businesses.